Welcome back. So, let us continue. Now, I will talk about the impact of interest rate volatility on option adjusted spread. Let me explain the underlying philosophy. You see, higher the volatility of the interest rate tree on the basis of which we are doing the computation, lower would be the value of the callable bond. Why is that? Because higher would be the value of the call option, and because in the callable bond the investor is short in the call option, higher the value of the call option, lower is the value of the callable bond. That is one fundamental feature, that higher, let me repeat this, higher the volatility of the tree, of the interest rate tree, or higher the volatility on the basis of which the interest rate tree is calibrated, higher the value of the call option, because greater the uncertainty, greater the value of the option, and because the investor is short in the call option, lower would be the value of the callable bond. So, if lower is the value of the callable bond, what happens to the option adjusted spread? Lower is the add on which constitutes the option adjusted spread, that you have to add to the risk free rate in order to arrive at the current market price. Let me repeat, lower the value of the callable bond, lower is the discount rate that you need to arrive at the current market price, and that means what? That means lower is the add on to the risk free rate that you require for arriving at the current market price, and that means what? That simply means that the lower is the option adjusted spread. So, higher the interest rate volatility, higher the volatility that goes into the calibration of the interest rate tree, lower would be the option adjusted spread. Let me now explain this by an example. Suppose that a 7% 10-year callable bond of XYZ is currently trading at 958. Assume that an analyst P assumes a 15% value for future volatility in generating the benchmark interest rate tree. He calculates the value of the bond as 1050. He then computes the option adjusted spread, the increase in discount rate. What is the option adjusted spread? It is the add on to the risk free rate which is required to lower the calculated value from 1050 to the market value, which is 958. Let us assume that the add on that is required is 80 basis points. Then this 80 basis points constitutes the option adjusted spread. Now, suppose another analyst Q assumes a 20% value of future volatility in calibrating his interest rate tree, then what will happen to the computed value? As I mentioned, the value of the call option will increase because of greater volatility, and because the investor is short in the call on a callable bond, the value of the callable bond will decrease. Let us assume that the computed value of the callable bond on this new tree, on the 20% volatility tree, turns out to be 992. So, now what happens? Now, if I try to work out that add on figure to bring this 992 back to 958, it will be lower than 80 basis points that I computed earlier. Let us say it is 54 basis points. So, the option adjusted spread has reduced from 80 basis point to 50 basis points. So, higher is the volatility that is used for calibrating the interest rate tree, lower would be the option adjusted spread. Hence, we find that for the same bond, the option adjusted spread calculated varies with the volatility assumption used. The higher volatility led to lower computed value and hence to lower option adjusted spread. Hence, when the estimated or assumed volatility of benchmark rates used in a binomial tree is higher, the computed value of a callable bond will be lower and therefore closer to the true market price. The constant spread that needs to be added to the benchmark rates to correctly price the bond, the option adjusted spread is lower. So, that is what it is, that is how it operates. Conclusion: when we use a higher estimate of volatility to value a callable bond, the calculated value of the call option increases. As I mentioned, the calculated value of the straight bond is unaffected. The computed value, not the market price of the callable bond, decreases because the investor is short in the call option, and the constant spread that needs to be added to the risk free rates, to the benchmark rates, to arrive at the correct market price of the instrument, therefore decreases, and this is nothing but the option adjusted spread. Therefore, the option adjusted spread decreases. So, this is a summary of what I have talked about calls and for puts. To summarize, as the assumed level of volatility used in the interest rate tree increases, the computed option adjusted spread for a given market price for a callable bond decreases. Similarly, the computed option adjusted spread for a puttable bond increases as the assumed level of volatility in the binomial tree increases. Now, we talk about swap rates and swap spreads. What is a swap? A swap is basically an exchange of cash flows. A swap is an exchange of a sequence of cash flows, rather. Let me be more precise. It is a sequence of, it is an exchange of a sequence of cash flows. Usually what happens is that the value of each cash flow in the one leg of the cash flows is determined with reference to a particular market variable, and the other leg of the cash flows is independent of that market variable. For example, one leg may be determined by the current interest rates, which is usually called the floating leg. The other leg may be independent of current interest rates, may be based on a predetermined fixed interest rate, and that is called the fixed leg. So, typically in fact, the most important, the most common swap that we have in existence that is traded the most is the interest rate swap, where the one of the legs is of cash flows is based on a fixed rate of interest, and the other leg of the cash flows is based on a floating rate, an interest rate which is reset at periodical intervals in line with the provisions contained in the swap contract. So, in a plain vanilla interest rate swap, one party makes payments based on a fixed rate, while the counterparty makes payments based on a floating rate. The fixed rate in an interest rate swap corresponding to the floating rate is called the swap fixed rate or swap rate. So, let me repeat, in the case of a swap or an interest rate swap, which is the most common type of swap, we have currency swaps also, we have equity swaps also, but let us stick to the simplest swap. Time permitting, I shall talk about other types of swaps as well, but for the moment let us restrict ourselves to interest rate swaps. Interest rate swaps involve an exchange of cash flows such that one of the cash flows is determined on the basis of a rate which is fixed at t equal to 0, and the second cash stream of cash flow, second leg of cash flows is reviewed at periodical intervals based on the then prevailing interest rate, and accordingly the cash flows may change over the life of the swap contract. So, the fixed rate corresponding to the floating rate that is agreed upon in the swaps is called the swap rate. Swap rate curve. If we consider how swap rates vary for various maturities, we get the swap rate curve. So, if at any point in time we plot a curve with the maturities along the x axis as usual and the swap rates along the y axis, what we get is the swap rate curve. The swap rate curve has become an important interest rate benchmark for credit markets. Swap rate curve features. Swap rate curve is preferred as a benchmark interest rate curve rather than a government bond, which we have been using so far as the benchmark. But now we come to now that we know what is swap rate, we shall also talk about its relevance insofar as valuations are concerned and insofar as the utility is concerned. So, swap rate curve is preferred as a benchmark interest rate curve rather than a government bond yield curve for the following reasons. Number one, swap rates reflect the credit risk of commercial banks rather than that of governments. Swap rates reflect the credit risk of commercial banks rather than that of governments. The swap market is not regulated by any government, which makes swap rates in different countries more comparable. Government bond yield curves additionally reflect sovereign risk unique to each country. So, swap rates do not have that particular feature. The swap curve typically has yield quotes at many maturities, while the government bond yield curve has on the run issues trading at only a small number of maturities. So, the spectrum of government interest rates or spectrum of interest rates that are available for plotting the government spot rate curve is usually limited. Swap rates are available for more closer maturities or for more closely spaced maturities. Now, a more technical definition of swap rate. A swap rate is the average of the fixed rate that a swap market maker is prepared to pay in exchange for receiving LIBOR, that is its bid rate, and the fixed rate that it is prepared to receive in return for paying LIBOR, that is the offer rate. So, the technical definition of swap rates, an improvement on what I mentioned a few minutes back, is that it is the average of the bid rate and the offer rate, where the bid rate is the rate that is the fixed rate that the market maker is willing to pay in exchange of LIBOR, and the offer rate is the rate that the market maker is willing to receive in exchange for the LIBOR rate. Now, swap rate means that a bond with a principal of $100 and a semi-annual coupon equal to the swap rate per annum sells at par. So, if x is the swap rate, then if you have a coupon of x by 2 at intervals of 6 months, then the bond with this kind of interest payment should be selling at par. For example, the 5-year swap rate is an interest rate with a credit risk. 5-year swap rate is an interest rate with a credit risk corresponding to the situation where 10 consecutive 6-month LIBOR loans are made to companies with an AA credit rating. 5-year swap rates are less than 5-year AA borrowing rates. Now, 5-year swap rates are less than 5-year AA borrowing rates. Why is that? Because you see, when you are talking about a 5-year AA borrowing rate, that rate is determined at t equal to 0, and that rate is fixed for the entire 5-year tenure of the loan. I repeat, when we talk about the AA borrowing rate for 5 years, what we are trying to say is that this interest rate will hold irrespective of what happens in the next 5-year period. The lender does not have discretion to modify that rate over the life of the loan. However, in the case of a swap rate, what is happening? In the swap rate, you are basically giving a loan on the premise that the interest rates would be this rates prevailing at 6-month intervals of companies that have credit worthiness of AA at all times during this at all times of review of the 6-monthly intervals. Let me explain it a bit more in detail. Suppose you have made a loan at t equal to 0, then the company should have an AA rating at t equal to 0 for 6 months. Or for a 6-month loan, that is. Then at t equal to 6 months, when you review that loan company should have a AA rating for that 6 months, and so on. So, this rate, this 5-year swap rate corresponds to the rate over the 5-year period with 6 monthly review points. So, let me read it out now. It is much more attractive to lend money to successive 6-month periods. It is more attractive to lend money for successive 6-month periods to borrowers who are always AA at the beginning of each such period. This is important. AA at the beginning of each such period than to lend it to one borrower for the whole 5 years, when all we can be sure of is that the borrower is AA at the beginning of the 5-year period. So, that is basically the difference. In the case of a swap rate, you are making loans at 6 months or you are deemed to be making loans. The rate is fixed on that premise that you have made a 5-year loan, but that loan is such that at every 6 months you review the credit rating, or you make the loan to a party, not necessarily the same party, to a party who has a AA rating at that point at which you make the loan. In the case of the fixed rate loan, that review of credit rating is only at t equal to 0 and not subsequently up to t equal to 5 years. In the case of the swap rate, the review is at 6 monthly intervals, and that loan need not necessarily be to the same party. It will be deemed to be parties at who have the credit rating of AA at the beginning of each 6 monthly period. Now, that is important. Please note these are deemed lendings. In both cases they are not real lendings. So, that is the reason why when you fix the interest rate for 5 years in one go, obviously you have greater risk attached to that loan. The credit risk of the party may deteriorate over the 5 years and you cannot do anything about it. So, naturally you will demand a higher rate compared to the swap rate, where the review is at 6 monthly intervals, and the loan may also not be deemed to be to the same party, but to a company, whichever company that is, that has a credit rating of AA at that point, at that review point, which are 6 months apart. So, naturally the interest rate would be slightly less compared to the 5-year fixed rate. Zero rates and swap rates. Zero rates are YTMs. Zero rate is the YTM of a zero coupon bond, as I mentioned. Swap rate is the fixed rate that the receiver demands in exchange for the uncertainty of having to pay the short term LIBOR rate over time. So, that is the rate, that the fixed rate corresponding to the floating rate, which is the LIBOR rate at 6 monthly intervals. Let us do this example. The market on a particular day is quoting a swap rate of 5% for a swap whose payments are made semi-annually. Suppose the 6 month, 12 month and 18 month zero rates have been determined and are 4%, 4.5% and 4.8% with continuous compounding. What is the 2-year zero rate? Now, the swap rate of 5% means what? Means if the face value is 100, then a coupon of 2.5 at the end of 6 months and a coupon of 2.5 at the end of 1 year would mean that the bond would be quoting at par. So, that is what is meant by the swap rate. A swap rate is that rate at which, if semi-annual payments are made at half of that rate, the bond would be quoting at par. So, here is the solution. If you look at the solution, 2.5 at the end of 6 months, this is being discounted at the 6 month zero rate, which is 4%. This is here. The 2.5 that is occurring at the end of 1 year is being discounted at 4.5%, which is here for 1 year, and then you are getting 2.5 at the end of 18 months, which is being discounted at the 18 month spot rate, which is 4.8, and then you have a cash flow, final cash flow of 100 of principal and 2.5 of the coupon, and that is being discounted for 2 years. So, we have 2R, where R is the 2-year spot rate. Now, on solving this equation, and this must be equal to 100, as I mentioned, if there are semi-annual payments equal to half of the swap rate, then the bond should quote at par, and that is precisely what we are saying. Half of the coupon payments, coupon rate is 5. So, half of this is 2.5 and it is being made semi-annually, and then of course, the repayment is made at the end of the life of the bond, and the bond should be quoting at par. When we solve this equation for R, we get R is equal to 4.953%. Swap spread. Swap spread refers to the amount by which the swap rate exceeds the yield on a government bond. So, this is simple. Swap spread refers to the amount by which the swap rate exceeds the yield on the government bond, with the same maturity. Swap spread is equal to swap rate minus treasury rate or treasury yield. Swap spreads are almost always positive. Why should they be positive? Because the swap rates refer to risk which is greater than that for government instruments, greater than government treasury instruments. Swap spreads are almost always positive, reflecting the lower credit risk of the government compared to the credit risk of banks that determine the swap rate. So, naturally, because the swap rates pertain to banks which have a higher credit risk, the rate would be higher compared to that for the government which has a lower credit risk. I spread. The I spread for a credit risky bond is the amount by which the yield on the risky bond exceeds the swap rate for the same maturity. So, I spread of a risky bond is equal to yield on the risky bond minus swap rate for the same maturity. While a bond yield reflects time value of money as well as compensation for credit and liquidity risk, the I spread reflects only what? The time value is eliminated by deducting the government the yield on the government bond. This particular part that we have here, the swap rate for the same maturity, this eliminates what risk? This eliminates the time value risk, and therefore, when you remove this risk from the yield of the risky bond, the I spread of the risky bond is a measure of the credit and liquidity risk alone, not of the time value. The time value is eliminated either by the government treasury rate or the swap rate. In the case of the I spread, we use the swap rate as a measure of the time value, and therefore, when we are deducting the swap rate from the yield on the risky instrument, we are eliminating the time value impact and we are retaining the riskiness insofar as the credit and liquidity is concerned. Now, we start a new chapter which is interest rate risk. Now, when we make an investment in a bond, let us assume that t equal to 0, t equal to 0, I have made an investment in a bond. Let us say the maturity of the bond is t equal to capital T, and let us assume that my holding period of the instrument is not equal to the maturity of the bond. Let us assume that my holding period is less than the maturity of the bond. Let us see, it is somewhere here, t equal to h. So, because my investment horizon or my holding period is less than the maturity of the bond, what will happen? At t equal to h, which is the culmination of my holding period, I would like to dispose of the bond in the market, and whatever proceeds I will get, that will determine the yield that I have on my instrument. In addition to that, I would also be receiving coupons at t equal to 1, t equal to 2, t equal to 3, and so on. I would obviously, as a prudent investor, if I do not need the money at t equal to 1 or at t equal to 2, but I receive a certain amount of money, I am not going to keep it idle in my cash box. I would reinvest it somewhere. So, this the coupon that I receive at t equal to 1 would be reinvested until h. The coupon that I receive at t equal to 2 will be reinvested until h, and this way. In other words, what I am trying to say is that all the coupons that I receive at t equal to 1, 2, 3 up to t equal to h minus 1 will be reinvested until t equal to h, and then when t equal to h arrives, I will sell the bond in the market and get the disposal proceeds, sale proceeds. So, that will all these two things, the value or the proceeds of the reinvested coupon that I have, and in addition to that the market value of the bond, the aggregate of this will determine the return or the yield that I have obtained on my investment in the bond. Now, so far so good. Now, suppose at a certain point in time, let us say very soon after I make the investment, the interest rates make a change. the interest rates change. Let us say the interest rates increase. Let me say that the interest rates increase. Now, if the interest rate increase, what will happen? The coupon that I will invest at t equal to 1 will obviously be at a higher rate compared to the rate that I have planned at t equal to 0. Similarly, the coupon at t equal to 2 will also be at a higher rate because compared to the rate that I have planned at t equal to 0. In other words, what will happen is that the reinvestment income, the value of the reinvested coupons that I received at t equal to 1 and invested for h minus 1 years, that I received at t equal to 2 and invested for h minus 2 years, all the reinvestment proceeds of all these intermediate coupons will increase because the reinvestment rate has increased. And why is that? Because we are assuming that the market rate has increased. So, obviously reinvestment would be at the relatively higher market rate. But what about the sale proceeds? As far as the sale proceeds are concerned, what will happen? How do we determine the value of a bond? We discount all future cash flows let us say this is h, this is h plus 1, h plus 2, h plus 1, h plus 2 and so on. This is capital T. All the coupons that are going to be paid at t equal to h plus 1, h plus 2, h plus 3 up to t equal to capital T, these would be discounted, and when they are discounted, the value that we will get at t equal to h will determine the market price of the bond. Now, what happens if the market rates have increased? If the market rates have increased, what does it mean? It means that the discount rate has increased because the market is now demanding a higher return. So, the discount rate has increased. If the discount rate has increased, what happens to the market price? The market price, which is determined how? Which is determined by discounting all future cash flows at the relevant risk adjusted market rate. So, if the market rates have increased, the discounted value will decrease, and as a result of which the market price will decrease. So, there are two opposing effects if there is a change in interest rate. That is the important thing. That is the fundamental thing that we need to understand. If there is no change in interest rates, well and good, very fine, we continue as per projected, but we know that interest rates do change, interest rates do have volatility. So, therefore, if there is a change in interest rates, two opposing factors come into play. The first factor is due to the reinvestment income. If interest rates increase, the reinvestment income increases. If the interest rates decline, the reinvestment income decreases. However, there is another thing called the capital gain. The capital gain is the profit in some sense that you in a very simplistic sense, capital gains is the profit and that you make on the investment, and if interest rates increase, that capital gain decreases. If interest rates increase, the capital gain decreases, and conversely, if interest rates decrease, the capital gain increases because the price at which you are going to liquidate the bond increases. If the interest rates increase, the price decreases, therefore, the capital gains naturally decrease. If the interest rates decrease, the price increases and the capital gains increases. So, these are two opposing effects, and they would take place if the interest rate changes during the life of your investment. We shall continue from here in the next lecture. Thank you.